Welcome to our December quarter update. Hope everyone had a great new year and a Merry Christmas. Obviously last year was quite a strong year. Markets up nearly 40%, and for the first time in a long time the currency was helpful and it would decline about 15%. We're basically now in a situation where equity is probably best described as not expensive but also not cheap. And so there's a bit of a dilemma in terms of how we're going about investing new capital. I think probably the best way to illustrate it is to refer to a couple of the stock charts of stocks that we own in our portfolio. First one is probably Howard Hughes, property investment, Las Vegas theme that everyone knows well. But if you take a look at the chart, you'll see that over the past year it has performed quite strongly. Up 40, 50, 60%. And as a result, even though we're still happy to own it, we probably wouldn't put new capital into it at this very point. We'd rather wait for a bit of a correction. If we then go to the next chart, Wells Fargo, one of our banking stories, and pretty much illustrates what's been going on over the last 5 years. The beginning of the period, you had a sharp uplift from the very depressed levels post-GFC. And then the stock sort of treaded water for 2 or 3 years as the market was concerned or wasn't 100% confident that the US economy was in fact in recovery mode, and therefore we're not willing to expand the multiple on the stock. And then as the market over the last 12, 18 months has become convinced that in fact the US economy is recovering, you'll start to see earnings growth. The stock's taken another leg up and again has been a very, very strong performer recently. So at the moment it sells on a reasonable multiple, but it's obviously changed a bit over the last 12 to 18 months. So again, in terms of putting new capital to work, our view is that we probably just want to be a little bit patient and wait for something to happen in the markets. If we then go to our next example, which is Google, again exactly the same story as Wells Fargo, the sharp uplift after the post-GFC. Then it goes sideways for a couple of years as the market's toing and froing in terms of the economic recovery and what's going on in Europe. And then the last 12 to 18 months, very strong performance as earnings comes through. It's very clear again that the economy's moving ahead. So bottom line, we sit here today. I think we mentioned that in our newly listed vehicle, we're still sitting with about 100% cash because, as those charts illustrate, there has been significant changes in valuation stock prices. So I think we've just got to be patient short term and wait for the stocks maybe to come back to a level that we're again happy to deploy new capital. So in terms of where we head over the longer term or medium term, tough to know at the moment. The reality is we're in uncharted waters in terms of the significant impact that the Fed has had with their bond purchases. We're just at the beginning of the tapering, and again, people will speculate on what they think might happen, what the impact might be, but the reality is we don't know. We're just going to have to look at it in hindsight. But one thing that is very, very clear is that we're coming to the end of a 30-year bull market in interest rates. And again, I think we're referring to a slide which highlights the double-digit yields that you used to get 30 years ago. They troughed recently about 2.5%, and with the Fed starting to taper, my suspicion is that that's the end of that bull market. And we're now going to have a situation where interest rates are going to be rising for the next 5 to 10 plus years. Initially probably slowly, they'll then sort of gather steam, and as is typical, some point down the track they'll get very, very aggressive, and that's probably the time that you obviously want to sell equities. But as I mentioned, in the meantime, it's a bit hard to know exactly what the impact will be. One thing that is also clear though, along with the fact that interest rates have probably come to their end, is that 30-year downtrend in interest rates has probably driven an over-concentration of particularly retail investors' investment portfolios into the so-called classic defensive yield type stocks, whether it was property trusts, whether it was banks, anything with a high predictable yield and a high payout ratio. And as I say, the fact that you've had 30 years of interest rates falling at your back has reinforced those trends. And I suspect that most people have become very overweight in terms of their personal portfolios. We've got a chart that we're referring to that highlights that 60% of domestic retail investors' equity earnings are in banks. And that's interesting because over the last quarter in our Australian fund, we sold all of our bank holdings out of the portfolio because we believe that valuations have started to reach their upper limit, and therefore we should be putting the capital aside and waiting for better opportunities. So I guess the point we're trying to make is that when you have big, long trends in the markets, and as they come to an end, you typically get people owning too much of that trend, being over concentrated in that. And with the turn in interest rates, I think people have to have a really hard think about how their portfolios are allocated, and they probably need to change their weightings. One of the reasons that we brought out the LIC was to highlight to investors that probably the risk-reward proposition is now starting to tilt towards offshore assets as opposed to onshore. Now the reality is, as I mentioned, the currency has declined 15%. Short term, it might stabilise, might bounce a little bit. We still think the longer term trend is down. Probably should be trading around the low 80 cents at this particular point of time, and the rest will determine on how big an impact China has on the commodity markets going forward. So as a result, even though as I said, the currency has declined, we're continuing to remain unhedged in our offshore portfolios. Apart from that, as I say, there's nothing that really stands out at the moment. We're kind of doing a lot of work on a number of different areas in terms of finding new opportunities for capital. But at the moment, we've basically reduced to probably 65% invested, and sticking with some of the themes that have been consistent over the last 2 or 3 years, but looking very, very hard for new opportunities. In terms of Fed tapering and the turn in bond yields, I suspect that will also have a significant impact on Asia over the next 5 to 10 years. Again, they've had one trend at their back, and that's about to change. And I guess in relation to Asia, Kevin Bertoli, our fund manager, is going to talk a little bit about what he sees there. Recently went on a trip with Ashley Pettit, our global portfolio manager, to the US, doing some background research on a number of Asian stocks that have investments either in America or influenced by what's going on over in the United States. I'll let him talk about that. But I would like to put a plug in for his fund, because over the last 5 years, no matter what time period you look at, he's probably been ranked number 1 or number 2 in his peer group of about 40 managers, and generated significant returns in excess of the benchmark returns, and in my opinion certainly deserves to be on the approved list for Asian funds. So it's something that if you're not using the fund and do invest in Asia, please have a look at, because I think he's well and truly earned the right to be considered as one of your Asian fund managers.
Thanks for that, Paul. During the quarter, we undertook our annual research trip to the US. We visited 30 companies in 8 to 10 major cities over the space of 3 weeks. It was clear to us from the trip and previous trips we've taken to the US that the environment continues to recover nicely. Majority of the companies that we met continue to see improved operating metrics and operating environment for their businesses. But it was refreshing to see that none of these companies were taking the recovery for granted and were fairly conservative in their estimates. Although we understand that recovery in the US isn't going to be in a straight line, we think the current environment and the outlook bodes well for our holdings. Essentially, you've got structurally low wages and rising energy production, which are basically boosting a resurgence in US manufacturing. You have an improvement in the labour markets driven by an improvement of the property markets and construction. And finally, you also have fairly low consumer prices, which continue to be a benefit for the end demand. While on the trip, we also did an extensive tour of US gaming assets on the East Coast, and also finished in Las Vegas, where we met with the operators there to discuss their outlook for Macau, which is a major component for our Asian fund. Las Vegas continues to recover quite nicely and should be driven by a strong convention cycle in the first half of this year. Howard Hughes, a major part of our global fund and the largest residential owner, a landowner in Vegas, is essentially feeling strong enough with the recovery in Vegas to progress with their Summerlin Shops development, which is the first kind of vertical development that they've done within that master plan community. Longer term, we think this drives volume and price for their residential land. In terms of Macau, we came away with a strengthened conviction of our view there. Essentially, Macau and Asia is going to be the focus for the US gaming operators going forward. We think the current dynamic in terms of the competitive environment remains very stable. You have a decreased aggressive stance from some operators in terms of commissions. You have no new capacity coming on until 2016 at the earliest. So we think these two factors bodes fairly well for the existing operators. The existing supply should therefore benefit from what we see as very strong growth in visitor arrivals over the next couple of years. In terms of the risk to Macau, we actually think they're manageable at the moment. The two main ones being, a crackdown on the VIP business, which is actually becoming a smaller part of operations, and licence renewals and new licences. We think both of those factors are fairly maintainable or manageable. The third part of the trip was going down to Mexico for the annual Heineken Forum. Heineken basically got together the management teams from across the Americas to present, with particular focus on the Mexican business that they acquired in 2010. We think there's substantial opportunity to grow that Mexican business in particular, and that's kind of twofold. One on market share gains. They have a very strong suite of products against their competitor across different points in the pricing spectrum. And secondly, margins are about half that of their nearest competitor. So the outlook for Heineken, we came away from the trip, fairly happy with. The business trades on an ungeared yield of about 9%, and what you're seeing is an increased exposure to developing markets with acquisitions in Latin America and Asia over the last couple of years, which bodes fairly well for growth going forward. So from me, that's it, and I'll hand back to Paul.
So in conclusion, it has been a big year for financial markets, and I'd reflect back on just how much sentiment has changed. I'm sure you see that amongst your clients. 12 to 18 months ago, we found it very, very hard to get people to invest in the equity market, but that has definitely changed. And that probably tells you that you want to be a little bit cautious short term, and that's in fact what we're doing. We're just basically being patient and waiting for stocks to now come back to levels that we want to either invest in the same stocks again, or hopefully the work that we're doing at the moment, when we come back at the end of the March quarter, we'll actually have a few new additions for the portfolio. I'd also encourage you to send us any questions if you have any feedback either on the webinar or the quarterly report, but in particular any questions that you might want us addressed. Do you want us to talk about any stocks, anything of that nature, please email Rob Thompson or Chris Donoghue. And we will endeavour to incorporate that in our next quarterly report or webinar. So with that, I'll sign off and let's see how the next quarter goes.